7 has played a pivotal role with my clients, offering clients software that enables high quality research and advice in the pursuit of consistent and profitable trading. I'm also an affiliate member of the Market Technicians Association in the United States, and I am a responsible manager for what's called an Australian Financial Service License, which is our regulation by our Australian Securities Commission within our region. Today's presentation will take approximately 45 minutes. If you have questions, you are most welcome to type them into the question panel, which is in front of you. My colleague Jim Graham, who's sitting in Chicago, will assist me by answering questions via that question panel. And if you would do me the courtesy of recognizing that question panel by just typing in your nearest capital city or just say hello, it tells me two things. One, you recognize where the question panel is, and two, I'm fully aware that you've got good sound and we're ready to go. Thanks, Alan. At the end of this presentation, I would like to gauge your interest in this software that I'm about to present. This presentation will demonstrate the opportunities offered by OptionVue 7 and the earnings report or the earnings play module, and hopefully start a conversation about trade management and individual trades, which I call objective setting. So I've got a little bit of a different theme than maybe other presentations that have been done around the earnings report. And the theme of my presentation today is about goals, objectives, and tactics. During this presentation, I would like to conduct two polls, and I'll do one shortly to get to know you as a group, and I may adjust what I say in this presentation according to who you are. Everybody in this room has a common purpose. The people that I generally present to are new traders, experienced traders, and sometimes advisors looking to diversify advice given to clients. Including myself, we all want to achieve a similar thing. We all want to grow the value of our trading accounts. We all want to achieve growth with a minimum of drawdown. But it starts with recognizing shared problems and an understanding of the opportunity offered. The problems that I hear from my clients, but I believe are universal, is that people tell me that I waste a lot of my time looking for trades, or I already know how to trade, but I'm not consistent, or I am time poor and do not have the ability to, or the time, to systematically identify trading opportunities, or last of all, I don't know how to manage a trade. It begs the question that as a trader, how can I find trades that will potentially enable me to achieve consistent results? The answer, you can take control of your trading by implementing a series of trades identified by OptionVue and the earnings play module. Just as we get warmed up into this presentation, I really would like to do a poll. And if you do me the courtesy of answering the poll, I'll show you the results. I just wish to ask a simple question, and that is, let me put up the poll. The question is, on screen, do you have a current subscription to OptionVue 7 and the earnings play module? I would really like people to answer one of the three answers. Yes, I have a current subscription to OptionVue 7. Yes, I have a current subscription to OptionVue 7 plus the earnings play module. Or you have no subscription, but yes, I am interested. 51% of people in the room have voted. If you could just, we get it up to 80%, I'll click the button and I'll show you the result. And what it does, it tells us, everyone in the room, who we are, because geographically we're absolutely dispersed across the world. But this is getting a sense of who we are. 71% of people have voted in the room. I think that's a good sample. So let me just close the poll and I'll show you the result. There we go. 48% of people in this room do own a subscription of OptionVue. 8% have OptionVue and the earnings play module, and 44% are very, very interested. So that's quite interesting, and now you've got an idea of who each other is within this room spread across the world. Let's come out of that poll. and come back to the presentation. Let's get started. Earnings season, as we are all aware, is a period of time during which a large number of publicly traded companies release quarterly earnings reports. The earnings play module within OptionVue 7 is a new and unique method of trade discovery that may change the way you trade forever. As individual traders, our goal is to produce a profit derived by the edge given to us by the earnings play module within OptionVue 7. Let me just come back to the word edge. I underlined it for a really good reason, because over the decades, I've promoted myself and I've actively engaged as a sell-side analyst within my region. And my daily routine, if I was to give advice, is extensive, it starts with a macroeconomic viewpoint, a sector, an industry, and a stock viewpoint, which takes me hours to produce. So what is the edge that the earnings module can deliver? It delivers an edge of time. It delivers an edge where you don't have to be the analyst and you are able to concentrate on being the trader. So we know what our goal is. Our goal is to produce profits, but what I have observed within my clientele base is that they don't understand that in turn, we need to understand our objectives to grow our wealth by the way we manage a trade from each opportunity offered. And last of all, we may use different tactics to achieve our stated objectives. I just want to make sure people know what I mean by objectives, because I'm going to do some demonstrations in a moment which show you how to detail objectives within a specific trade selected using the earnings report. The objectives of a trade have to be defined. Objectives are exact steps we take as traders to reach our goal. What's our goal? Our goal is to produce profits. So the objectives formulate a plan that is written down and are realistic and attainable. Sometimes differing tactics may be required to achieve our objectives. So our function as a trader, we all know it's to make the right decisions that maximize every opportunity offered to us by every trade. The opportunity, by definition, is a series of trades generated by the earnings play module. The challenge is to define a set of objectives which result in a relatively stable rising equity curve with a minimum of drawdown. Let me go straight to OptionVue and let me straight away demonstrate what I am talking about when I refer to this thing called the earnings report. The earnings report module is a series of algorithms which are designed by Leonard Yates to find specific constants in the market. And this is really very, very important to myself and my own trading, because I only will apply a specific option strategy if I can forecast a specific market environment that fits that particular strategy in the context of time, price, and volatility. So within the earnings play module, there are a number of differing algorithms which can be used to do different activities. For example, if you look down the bottom of my screen, I've got tabs on screen. The first tab is something called the prime non-mover. They're stocks that are sought out by the algorithms to identify historically stocks that don't make a move. So they're designed to use in the context of, overvalued options, and they would be suitable for a specific strategy such as a calendar. Or alternately, we might be going for something called the E-prime or the prime movers. This is where the algorithm is seeking out stocks that historically make abnormally large moves around earnings dates, and they are suitable for different type of strategies such as a straddle, even in the context, and I'll address it, even in the context of expensive premium. which I'll show you a graphical representation of that soon. There are a number of other different tabs on screen, which are all individually bringing in different opportunities into your screen on a Monday. So when you come to work on a Monday, you open up your OptionVue, it'll prompt you to click a button, and I'll show it to you in a moment, where you bring in opportunities which they've brought straight to your screen. We have other algorithms within the product called earnings pairs, which involves two stocks that are making announcements. We have another algorithm within the product, which is called an echo, again involving two stocks within the same industry. And last of all, and I understand this is extremely popular within the Chicago office within overseas, and that is runners. These are stocks that tend to run on announcement days, and essentially we're trying to determine the direction early on in the session, and then take the direction that market takes for the next first 15 to 20 minutes and drive the profits for as hard and as long as we can throughout the session. Today, there's no chance I can cover in detail every single algorithm. In fact, my objective was or I wanted to do calendars and straddles. I'll be lucky to do straddles in detail today, but I'll do my best. So we've got these number of algorithmic plays that can be brought into the software, and they're brought in, or can be even manually brought in, by coming up to the top of the screen and clicking an import earnings play calendar date screen. Now I'm not going to click it because I've got my screen set up for this presentation, but what we can see on screen are a number of different candidates that can be brought in, which are the prime movers, the non-movers, the earnings pairs, echoes, and runners. We'll also notice we have got a minimum quality ratings on screen, and we can also notice that we've got dollar value of options. We've got a minimum stock price that can be set, and another quality rating, which can select over the last 2 years how many trades were successful. So you can go, if you want a large volume of trades, you can reduce your quality ratings. If you want higher quality trades, you will increase your quality ratings, but it will decrease the volume of trades you're getting. And that would also be true with the number of successful profitable trades. If you want a high volume of trades, reduce the number to 1. If you want a lower volume of trades, but a higher quality trades, increase the number to 5 or 6 even. But then you're coming to groups of trades which are historically quite successful, but you're going to get a small number of trades. What is really, really useful too for someone like myself who's extremely busy dealing with numerous clients across my region, and that is something called the weekly earnings planner. I am in back trade at the moment because I don't think it's fair to be operating in real time, although I may switch to real time to show you something before we finish. And using the planner, I take a screenshot of this every week. I stick it up on my wall and I circle what I'm interested in for the week ahead, and that's how I plan my week. For my clients that are owners of the earnings play module, I will take a screenshot, put big circles and make sure they're aware. That's what I'm helping them to ensure that they're getting the best out of their product, and assisting them if required to, I'll assist them to do whatever. I'll assist them to put in a trade if they want me to. I'll do whatever it takes to ensure that we're getting the best performance out of their dollar spent on this particular module. Let me just close the calendar just for a moment. And let me just come across back to my presentation slides. And let me just start discussing why this is an opportunity in the context of specific strategies. And then I'm going to progress, and I'm going to do some back-traded examples. And there's something which I think is a little, not unique to everyone in this room. Maybe it is, but I'll show you something which I think is interesting. Why is it an opportunity for options traders? Well, let's say we pick up the first tab, which is the prime mover tab. Using the prime mover tab, now you can see a picture we can identify stocks that historically have large gaps during earnings report times. The earnings report algorithm is suitable for specific strategies such as a straddle, maybe a strangle, something that's going to have a very large percentage move. It's not just picking up any stock, it's picking up historically over the past 2 years with the algorithms grinding over the weekend and selecting and suggesting on a Monday those stocks that historically have gaps. Suitable for those of you who are aware of what a straddle looks like, a classic pattern where to make money, we simply need the market to move to the left and move to the right. It's a non-directional trade. It's actually what everyone wants, generally speaking, as a new trader. What do you want? You don't want to pick a direction. How many people in the room don't have to answer the question? Totally rhetoric. How many people don't want to pick a direction? Non-directional, and just take a trade and make money. Well, this is non-directional. You can buy a call and you can buy a put and placed around a constant, the constant being the earnings report. If the market has a large percentage move, you will make money. I want to address for the advanced people in the room very, very quickly this graph, because when I first come across lens development, it was a little bit counterintuitive to buy options in the context of overvalued options in relation to historical volatility. But that's the beauty of this algorithm. Even though we are in environments of overvalued premium, we are finding stocks that are making such large percentage move, it overwhelms the volatility crush that you experience as the earnings report information comes into the market. So that's usually what people jump straight on top of this. But I can tell you, over a large sample, there are losses and there are wins, but the average win is significantly greater than the average loss within the markets. So we've got E primes, which would be used for the straddle. We're looking to make big movements. Or the alternative could be, here's a different algorithm, which is the prime non-mover algorithm. This would be suitable for a different type of strategy. The non-moving algorithm, or the prime non-mover, is designed to identify stocks that historically have little movement in price around earnings reports. So you tell me, for those that are experienced, again, I'm really not asking for an answer, what sort of strategy may be suitable for non-price movement in the context of overvalued premium? The answer could be, and it's not the only answer by the way, could be exploiting volatility skew within the context of a calendar spread where we've got on the first or the last days to expiry using weeklies, very expensive mid-implied volatility as compared to the next chain out, 11 days to expiry. So what we're exploiting there is a situation of volatility skew and very expensive premium in the last 4 days on this weekly chain. The ability to model that volatility skew and model the volatility crush as we come into earnings report is the domain of a gentleman called Brian Johnson, and Brian was instrumental in allowing OptionVue to lift this product to be another level of excellence in the fact that now Brian's work in terms of the modeling of the volatility crush at earnings report times is now being fully incorporated into the OptionVue product and now operates and permeates through all the activities and functions through the product. That's been a fairly major development, and I understand it does it, and I understand, I've used it. It operates with an extreme degree of accuracy. So, in the context of for a calendar spread, for example, we want volatility crush, we want volatility skew, and we want to pick a strategy which is implemented at exactly the right time, the constant being the earnings report date, to extract premium from the market. So what have we got in summary? We've got prime non-movers, we've got prime movers, we've got earnings pairs in summary, we've got echoes, we've got runners, all of which are providing a constant stream of opportunities on a Monday, which you can pore over, where you don't have to do the analytical lifting and concentrate on being the trader, which is what we all want to be. Let's do some, or a little bit of OptionVue work, I think would be the right thing to do at the moment. And what I'd like to do is to demonstrate how we could apply prime movers to broad straddles. Remember, what was the theme of this presentation? Understanding your goal, developing an objective, and then employing tactics to meet your objective. So I'd just like to demonstrate, first of all, how we're going to do that with a straddle. And I can already tell you the way time's going, the calendar spread's going to have to wait for a future presentation if I'm ever asked to do it again. So I'm just warning you in advance, if you come straight for calendars, I'm sorry in advance. I'll also be using Backtrader or Backtrader to review some recent trading. I've selected a group of trades back in February this year to examine how I predefine objectives and how those predefined objectives impacted on the profitability of each trade. Just before I go over to the software once again, I want to use a bit of new terminology that I give my clients. What I like clients to start to understand is that something like a bought straddle, it's often promoted as a very simple strategy, is it not? It's so easy. We just buy a call, just buy a put, we're going to make money. That is not quite true. And that is an oversimplification of what's happening when you take a trade. Because when you take a trade, you have to have a set of objectives to make a profit. You know what your goal is. The goal is to make a profit, but the set of objectives is that thing that will deliver the profit. So what I'd like to do this afternoon is to divide my bought straddles into a term that you haven't heard of before, because I only made it up, and I'm going to call them a category 1 and a category 2 trade. A category 1 trade are trades that have a massive gap and everybody's happy, and a category 2 trade is one that doesn't. And I want you to start thinking in the context of objectives and tactics to tackle two very different environments. So on screen, and I'm going to shift across to the chart in a moment, we can see on screen there's two red bars. One's fabricated, that's the number 2 bar, and the number 1 bar is real, where the market fell 12.7% in a 24-hour period, which is obviously an extremely great move and would deliver a trade. The point is, how do you maximize the profit in number 1, and how do you lock in the profit of number 2 at the same time? Well, you need to define, and some of this is pretty obvious, but it won't be when I do the next slides. Some of it is obvious that you need to place a stop loss and calculate something called the average excursion. Let me just demonstrate that by coming across to the software and opening up the price chart before the actual trade occurred. I am now in Backtrader and I've got Yelp up on screen, and we are on the day prior to the announcement. Before I go and reconstruct this trade, there's some very, very important information on screen that I, in my rush to talk, brushed right over the top of. The information is in the columns with the heading earn date and earn notes. Really important information, because in the earn date column to start with, we have some information that gives us the actual date of the release of the information, and beside, at the end of the earn date information, we've got the, I'm just going to come across to here, we've got, one moment, I clicked the wrong button, we've got AMC and BMO, so after market close and before market opens. Really important things for anyone that doesn't understand the terms. It's determining what's called the effective date. if the effective date is when the information release of the earnings report impacts on the market. So this is very important because you need to know when to get a set in the markets to take advantage of the move. So if we've got an earn date of the 28th of April, AMC, what's the effective date? When is the market going to make its move? It's going to make its move on the 29th. We have to get set on the 28th because when the market closes on the 28th, after the market closes, then the information will come into the market and then the market will react to that information the following session. BMO, this one, MDLZ, some people call it Z. 29th of the 4th, BMO, before the market opens, what's the effective date? 28, 29 or 30? Before the market opens on the 29th, the effective date is the 29th. If you want to take advantage of this particular trade, you need to get set on the 28th. So this particular algorithm is giving you some critical information to get you positioned to take advantage of the information as it impacts in the market. There is also some other very interesting bits of information in the earn notes, which I breezed right over the top of. In the context of the earn notes, we've got a number 34, then a number 4 with a dash and a 6 and a letter C. 34, what was the first number representing? 34 represents over the past 6 trades, or in this instance, on the second one, over the past 8 trades, which is 2 years of history, a 31% yield on the average trade in the past 8 trades over 2 years. The 5-8 represents how many trades produced a profit over the past 8 trades. In this particular, it's 5 out of 8 trades produced a profit, and it's even giving a little indication as to when is the best time to close the particular trade. A C means on the close, a O means on the open. So there's some very important information sitting on screen to assist you to take advantage of what's happening. So what I'd like to do is just open up Yelp. Just give me one moment and let me open up the price chart and let me elongate the chart just to prove my point. Before we take a trade, we absolutely do not know what's going to happen. This market we know it's going to jump down. It could do anything. It can jump up, it can jump down. I'm just going to talk about this as a category 1 trade, and a category 1 trade in my terminology means that this market has a very large percentage move. Now, that's wonderful, and that seems like I've made money. Well, that's not true. Unless you've set your objectives. And your objectives, what are your objectives? Your objectives are that set of rules that make your profit. Your goal is to make profit, but there are a number of things that can happen when this market opens up. And the number of things could be market gaps down, market falls down. I need to just do that one more time because I've just made a mistake. Just give me one moment. Let me start again. Market gaps down, market puts in a tail, then falls, and at the end of the day, obviously you've made a profit. Now there's a problem with what I've just drawn there. The market had a tail. How do you handle the tail? You know, if you're sitting here at a live screen and the market starts coming up against you, you're watching your profit start to evaporate. What do? Well, this is what I do. I get my clients to calculate what's called an average excursion in a large sample of trades based on this stock, which is the excursion from the opening to the top of the tail. And I use that excursion, the average excursion, to put in a stop loss which is 1.3 or 1.5 times the average excursion. Now that has two things. What will happen? One, I'm not going to sit here and be upset if I get stopped out because I've locked in a profit. And if I don't get stopped out, market starts to fall and I start making more money than I am on the open. And in addition to that, stop loss calculation if the market does the reverse, and that is it starts to track up through the evening. I've got my stop loss already pre-prepared, it's already in the market, and when I say a stop loss, it could be a soft or a hard stop, meaning hard stop in the market, soft stop, you've got an alarm on your screen, and I've locked in a profit. Do not walk away from your screen without placing your stop or have a soft stop in place. Do not go fishing, do not play golf, because the number 2 bar could happen. You'll come back to your screen and you won't be very happy. That's 2 occurrences that could happen within the context of this trade. There's actually a third occurrence, and that is, or a third thing that you should be doing within your objectives, that is, how do we maximize the profitability of a trade? Well, what did the trade do if we don't get stopped out on the open? What does it do? It falls all the way through the night. So the third objective that you should have written down is a methodology for trailing your stop down, beneath, or just above the market. Now that volatility could take a number of different forms. And I must say that as I'm talking, if I'm using maybe terminology that you're not aware of, and you are looking for mentoring, I could do no better than direct you to Discover Options. My good friend Steve Lentz, who we spent 2003, it seems a long time ago, 2003 traveling through Australia doing a roadshow with the Australian Securities Exchange. Steve Lentz and his team from Discover Options are sitting there, and if you are not understanding maybe some of the terminology or the concepts, when I start to use volatility, the word volatility stops, please avail yourself of these guys. They're the best in the business, and it's really something. You should have the basics and the knowledge to not only understand me, but to implement some of the things I'm saying this evening. So the third thing that I'm suggesting in this market as it falls is a trailing stop in the form of a vol stop, or maybe a percentage stop, but everything is designed to have this market or maximize the profit of this particular trade. There's actually another thing that could happen in this trade. It's falling, but during the session, at the end of the session, she rallies, and the profit that you did have just evaporates. Now I'm talking to some traders in this room, and I'm actually making statements of the obvious, but what I'm not making statements of the obvious is when I ask a new trader to think in terms of your objectives and your tactics. The goal is obvious: to make money, to make profit, but what I find within some of my clients is they're not thinking the trade through enough to ensure that they're maximizing the opportunity offered to them by the earnings play algorithm. So I'm stimulating a conversation here, which I'm hoping you'll take on board. Okay, so in summary, very quickly, I have 2 types of trades within Straddles. I've got category 1 trades, which you know what can happen. There's a number of things that can happen, which need to have objectives and tactics. And I'll just in summary repeat, the objective 1 could be placing a stop loss on the open using the average excursion from open to previous high. Objective 2 could be a trailing stop in their various forms. And one of the tactics of the stop, the implemented tactic, could be to use a volatility-based stop. So, you know, objectives and tactics, we need to get on board with that level of thinking if we are going to maximize the benefits derived from the earnings play algorithm. Believe me, everyone in Chicago, everyone around the world who's dealing in this product, we're here to help. We want you to make money. We'll do whatever it takes. We want you to look at the best opportunities and take advantage of every trade offered. Okay, let me talk about what I'm describing as category 2 trades, and these are very interesting. You know, if you want to really quite an insightful review of, and I didn't mention it earlier, of Brian Johnson's work, Len Yates did a presentation which is freely available on the front page of OptionVue Systems, where he goes into it in a bit of detail. So I just keep on recognizing Brian, but Len has done a very, very interesting presentation which goes into that elements in a bit of detail. And in Len's presentation, he says his words, you will experience losses. I'll say it. You will experience losses and you will experience gains, but the average, and this is the key to all trading, the average win over a large sample of trades is greater than your average loss. So what I would like to address now is something that I advise my clients, and I'm using the term, I've made up the term, don't Google it, it doesn't exist, a category 2 trade. So what's a category 2 trade? A category 2 trade is a stock which actually does what it's supposed to do. It gaps, but the percentage gap is not enough to make a profit on the first 24 hours. So essentially, we have got insufficient move to post a profit. Some of you that already have the earnings play algorithm may have experienced it. Now, what are your options? Well, if it hasn't made a significant move within 24 hours, what are we faced with? A small loss. For those people that are okay with taking a loss, take a loss, that's fine. Because I've already made the statement, the average wins over a large sample of trades will be greater than your average loss. But is there anything we can do? Can we think out a series of objectives that could manage a category 2 trade? The answer is absolutely. And that's what I'm about to show you with some back-tested examples. What I'd strongly urge you to do is those people that don't have OptionVue, for a pretty slim $99 a month, all this can be tested. All this can be tested within their back-traded function. And this is what I strongly urge my particular clients to do before they start building up the volume of trades. These are the sort of things we do every day, every week, every month to get everyone all nice and revved up to pull profits out of the earnings play algorithm. So let's set a few objectives with my category 2 trade. So the first thing is to select the correct chain, to select the correct weekly option, and I'll demonstrate in a moment. And the second objective that I'm going to set is to have a greater window than 3 days. Okay, let me probably demonstrate with some back-traded examples. And I've got a series of trades that they're all back-tested. Okay, that's not my account. These are all a series of trades from February this year, and I've circled some of the trades which have got 7s and 12s and 21s, really tiny profits. Now I can tell you those 3 red circle trades are category 2 trades, but I turn them from a loss into a profit. Let me show you how. Just give me one moment. I just need to go over to OptionVue once again. And let me just access my presentation. And I'm going to start with a company back on the 11th of the 2nd. So the quickest way I can do this is just to type in the date, which is the 11th of February 2015. Hit enter and let BackTrader take me back to that time. For anyone who doesn't know what BackTrader is, it's probably the most beautiful tool that I've come in access with. And I've been associated with OptionVue since the 90s. I originally bought this product when I was a broker dealer to produce research for clients. At that point I was a futures broker actually. So the probably one of the best functions when this product, when it was released, was that they're capturing quotations in a half-hour increment. Now this is extraordinary, because what it allows me to do is, if I've got a theory, I can quickly go back in time, trade the theory as if it's real with slippage and brokerage, and work it forward to see if I'm on course with my theories. So again, for those people who don't know OptionVue, I can't impress upon you, if you can reconstruct it in a back-traded environment and repeatedly make money, there is a high chance that you're building up the competence and experience to actually trade for real. Okay, let's just have a look at the first trade, TWX. Now remember, I've already explained to you what a category 2 trade is. A category 2 trade is a trade that is not going to go anywhere. And I'm going to go a bit over time this evening, so I might have to speed up a bit. So here we are on the 11th of February. And if we look at the earn date, it's the 11th of February before the market opens. So in the context of this trade, when do we have to get set? In reality, if it's before the market opens on the 11th, we needed to get set on the 10th of February, correct? Effective date is the 11th. So with Backtrader on the 10th, here we go, getting set to have a trade. I've got brokerage and slippage. I'm negative on the entry. Going forward one day and the market doesn't move. Here we go. Let it just go jump forward. And we've got the market which does a range but basically doesn't move. I'm not sure whether you can see it on screen, but this particular trade is negative 284. Now this is what I want to get home to you. What's my goal? I want to make money. What's my objective? Well, I need a series of statements in my trading journal which tells me how to make money in any environment. So there are two things you can do as a straddle trader. You can go for high octane, you can go for high gamma and buy options in the very near dated series with 2 or 3 days to expiration. And that is where if you get a market movement, for those people who understand gamma, gamma is the rate of change of delta. For a $1 shift in the market, you'll get an extreme move in the options, to put it in summary. And that's fantastic. That's what we all want. Isn't it? Don't we want to make money quickly? That's great, but there's a problem. And the problem is, if you don't make the money within one day, you have painted yourself into a corner because there's only 3 days left in the trade. So there's no opportunity for you to turn a loss into a profit. So what I'm suggesting here is within the objectives, within straddles, maybe we don't go for the high octane. Maybe we don't pretend we're the Las Vegas trader, and maybe we're not going to go for maximum profit, and we're going to ease off and come out to the next chain with 10 days to expiration. With 10 days to expiration, I want those with the earnings report to earnings module to test it, and you can send me your results. In terms of a few more days to expiration, what I've uncovered is that within a 5-day window, most of the time, I'm going to turn this from a loss into a profit. I'll put it out there really quickly. So if I move forward 1 day into the future, I'm under no pressure to get out of this. I've got 10 days up my sleeve, and the market on the first day made a reasonable move to the upside, which reduces a $200 risk to a $34 risk. If I go one more day into the future, the market goes up, and I'm now positive. What I have shown my clients is that I really push them not to go for high octane, to bring off the gamma and come out to the next chain and give themselves a little bit of room. Now, why is that important? Well, I've got relatively new traders, and what I have seen is people get psychologically worn down after 2 or 3 trades, which don't make them money. So it's all really wonderful for an experienced trader like myself, or maybe Jim or Len, where we're used to taking losses. But I'm trying to show maybe a different ways, thinking in the context of objectives and tactics, how you could turn a losing trade into a break-even trade and move on, maintaining both your capital and your trading psychology to take the next trade. I could do a number of these, but I think I'm going to run out of time. Maybe I'll do just one more just to illustrate my point. And the next one, very, very, very quickly, I'll pick up Vodafone, which on the 5th of the 2nd, so let me do this really quickly. Let me close these two down. Come back to the 5th of the 2nd, and let me open up the price chart for Vodafone. VOD is a ticker code. Open up the price chart and the matrix. I've already pre-populated the trade, just making sure I've got it correct. Okay, when does Vodafone release its information? before BMO, before the market opens on the 5th, when do I have to get set? I have to get set on the 4th. Very effective. What's the effective date? The effective date is the 5th. The 5th is the date the information will impact onto this trade. So here I am, negative $50, which is brokerage and slippage, and I'm about to move forward one day into the future to the 5th. I'm obviously highly expecting a huge move to occur, and the move does occur. I do get a gap, but if you look at the scale on the right-hand side of the chart, it's gone from 36 to barely $35. It's a $30 stock. We need a $3 move to get 10%, and we're negative $2. I tell you, to be honest, if that was me, I'd be probably out of the trade, and if the market got on its low, I would probably be out of this trade. But let's play devil's advocate, and I'm sticking in the trade, and I'm not happy. I don't want to go negative. Well, within a 3-day time window, once again, I'll just jump forward 3 days. I'm getting to a point where I'm shifting the trade from a slight negative to a slight positive, and it's maintaining my psychology. I've got time. I've still got 5 days to expiration, exit the trade and move on. Now, maybe that's just a strategy that is not used very often, but I can tell you I actually used it this evening, and I not really should be operating in real time on screen, but it's okay because I've gone and deleted. You can't see any trades. These are all expired trades which have occurred in the last week, and I'll just highlight one trade. I only got out before I come online, and that's LinkedIn. Okay, this was a trade that occurred after the market closed on the 30th, and on its first gap, it was negative $200. Okay, it didn't gap enough, and it didn't gap enough to compensate for what was an extremely overvalued options environment. It just didn't do it. But tonight, 2 days down the track, it was plus $15 or $22 earlier on the open this evening, and it's a profitable trade, or it's a non-loss trade. So what do you want? Are you happy to wear small losses? If you are, just ignore everything I've said tonight. Or do you want to set objectives and tactics to minimize your small losses, maintain your psychology, and get the most out of the earnings play algorithm from the perspective of the straddle? Just quickly, these are the trades that have been pulled up. Many of these trades I've taken on my personal account. Twitter has been an absolute wonderful trade. US steel chart, fantastic, gap to the upside. Yelp, awesome trade to the downside. SunPower, fantastic gap to the upside. WFM, amazing gap to the downside. MDLZ, amazing move to the upside. So there's been a series of category 1 trades in the last 2 weeks. There have also been a series of category 2. I just shown you one, which is LinkedIn. In fact, I'm still in a couple of category 2 trades. I've still got 3 days to go to see if I can turn the small loss into a break even or a gain. Okay, I would like to just do a second poll, if I may, and just let me put it up on screen just to get some feedback from everyone in this room. The poll essentially says, and I really appreciate the feedback if you could, after you've seen this presentation, and I mean this is just a beginning for most people in the room, are you interested in making money using the earnings play module? If you believe it's a yes, I'd really I'd like you to click a yes. If you think maybe you're interested in the future, it's just not the right time, click the maybe. And if you think, and I'm actually going to show you the results, if you're not interested at all, just doesn't interest you at all, just click the bottom one. There's 40% of the people in the room have voted. I'd love to get it up to about 70%, which would be fantastic. While you're doing that, I'm just reading some of the comments that have been brought into the screen. So just give me one moment, because Jim's been tapping away in the background, and very, very good. I think I've answered most of the questions, and I'll unmute Jim just at the end so we can you know, clean up any other points that need to be talked about. Just the last few questions that I can see there is one from Harvey. Slides available to attendees, Harvey. Absolutely. This is being recorded, so you can have the not the individual slides, but you can have the recording of the slides. Absolutely fine. Sergi saying, I understand nothing. Sergi, maybe it's my accent, or maybe it's our understanding or your understanding of options. If it's my accent, I apologize in advance. If it's your understanding of options, please contact Steve Lentz from Discover Options at OptionVue tomorrow. Just have a chat to him about the basic education courses and start to develop the knowledge required to have a conversation in what is a large group of traders with a common purpose, and that is trading exchange traded options globally in whatever particular market we're involved in. Okay, 59% of people in this room have answered that vote, so let me show you the results. Just out of interest, it's always interesting to see what people are thinking. Technology, I love it. Let me share the results. Just give me one sec. So here we go. 35% of the people in the room said, yeah, I'm interested. 61% said maybe in the future, and 4% no, not interested at all. What I would suggest, once again, I don't mean to keep on pushing Steve, but this interested in the future, what may be holding you back is potentially your understanding of volatility skew and all these strange words, volatility stops and straddles and calendars. If I am speaking what is the language of traders, if I am speaking a foreign language, please, once again, seek help. You can even email me. I'm happy to assist in any way I can. That's if you become a buyer of the algorithm, of the module. Please don't use me up, but if you are a client of ours, I will do whatever it assists to assist you to get there. Okay, let me hide that module, that poll, and let me just do a final few words. Essentially, the earnings play module is designed to save you time by searching and identifying specific trading opportunities. It gives you the independence to trade on your own, and trades can be structured with small risk. It has low startup capital to start trading, and each trade is ranked by expected return calculated from previous history. Please know your goal. You know what the goal is. Plan your objectives and implement your tactics. If anyone is interested in this particular product, you are most welcome to go straight to the OptionVue website, and to get access to the earnings play module, you need a current paid up subscription of OptionVue for $99 with all the functionality associated with the product. It's not a big ask. The earnings play module is $2,400. Please talk to your representative in your region and they will talk you through the product. If you act now, you can subscribe by going straight to www.optionvue.com, or, as I've already stated, call your local OptionVue dealer today. Just as an extra gift for those people that are really interested, I've mentioned Brian Johnson's name a few times, in a book, Exploiting Earnings Volatility, this book as a gift, if you order before, I think Jim stated, the 15th of August, this will be an additional gift, which is an absolutely fantastic book, which complements the modeling within OptionVue 7. Thank you today for participating in this seminar. I just want to unmute Jim. Jim, you can say the last words. Is there anything that you'd like to say to anyone before we finish off?
Hi, thanks, Paul. Yeah, that went very well, I thought. I hope everyone really enjoyed it, and it's really perfect timing. And I always find an hour, including questions, is perfect.
Okay.
I will mention, of course, to anyone in here that has questions about the earnings module or didn't understand some of the ways that it worked, certainly they can always call a product rep here at OptionVue. They're all very familiar with it. Many of them trade it themselves, so they can pretty much answer a lot of your questions as well.
Okay, thank you very much, Jim, for your kind comments. And I think
you had mentioned.
Yeah, go ahead.
You had mentioned maybe doing another one, and I see that here. There are a lot of people that we left a few questions, and they're all very interested in your way of trading.
Okay.
Someone had mentioned something, a specific question on how you handled your example on Yelp.
Okay.
And I see a couple other questions that are things like asking about other strategies when you're doing it, like calendars, diagonals, verticals, butterflies. What how you're determining what weeks or expirations to use, and when you want to be delta neutral, things like that. So there's still a lot of interest, I think.
Okay, I'm absolutely open to doing a future presentation and shift the topic slightly. And if anyone in the audience, I will apologize because I've got multiple screens around me. I'm not actually focused in on the question panel. If there's a specific question, there goes my email address on screen. Remember, we're in different time zones, so you won't be getting me now. I'm running out of my office and going to sleep, but you're very welcome to email me at any time. And of course, if you contact Jim, he'll direct your inquiry to a product rep within his office. So I'd just like to thank everybody. That's it for this evening. Oh, sorry, for today. And I look forward to meeting you all or talking with you sometime in the future. Have a great day. Thank you.
Thanks, Paul.
Thanks, Jim. See you.